Alright, what's up everybody? This video I'm going to show you the only entry model that you'll need, why it's so easy, and why it works. So, I've been trading Asia, as you know. We've been killing it. We've had some setbacks here lately, but it's because I haven't stuck to my plan. But besides that, we're going to focus on time. And the times that we're going to focus on is the macros. So, during Asia, it's 650 to 710, 750 to 810. 850 to 910 or 950 to 1010. You pick any of them. 650 to 710, 750 to 810 is pretty good. Those are the ones I normally go with. But anyway, what a macro is that is time specific, and why that is important is because that'll narrow down our entry time. That way we're not trading all over the place. We've got a 20-minute window to where we're executing in only. And then when that window's over, we're done into the next hour. And basically what we're doing is either trading, waiting for the manipulation of the hour candle setup, the ending hour to end and the new one to form, or vice versa. But what a macro is, it's trading either into internal range liquidity, meaning a fair value gap, or external range, meaning it's creating a new swing point, the swing high or swing low. And look at these examples right here. We're on a 1-minute chart. NQ bounced down, gapped way down. So we might look for this to get filled in during New York. But so we go to our time window right here, 650. Okay, what are we doing? Right here is a bullish fair value gap that we inverted. Okay, so what we're going to look for there is that's a sign of bearish order flow. And we've created fair value gaps up here. So right at 7 o'clock, 7:01, we're in this fair value gap here. You put your short there, and your stop would be above this candle here. That's 774. That's 13 points of risk. And you'd be targeting at least this swing point right here because we've inverted this bullish fair value gap here. So when you do that and you don't take out a swing high and you're respecting a bearish PD rate, it's going to go to the swing point. And look what it does. It takes out that swing point before retracing and coming back. So this is the trade I actually took. We're at 702. This candle, we're in a bearish PD array during the macro. It's trading into internal range liquidity. We expect it to hold, and it does, and it goes from 759 to 23. That's 36 handles right there. That's a 1 to 3 in 10 minutes. So next example, let's just go to 8 o'clock. Okay, we don't see anything on a 1 minute. I've done the homework for you. We'll go to a 3 minute. And right here, 8 o'clock, we are trading into a bullet or a bearish fair value gap. And we have been bearish. If you go over the market structure video, we've been creating lower lows, lower highs, lower lows, lower highs. So if we are going to think this is going to continue, we would be short here, especially as we come into it and go down. So there we are again. Okay, and your stop would be, you'd be at 735. Your stop would be your, let's see where the candle is. 1, 2, 1, 2, 3. On these bigger time frames, you could put it over candle 2 if you want. Instead of candle 1, that'd be 5 points, or you could do it over the first candle. It's just a little more risk, but just say you did put it over the first candle. We're at 52, and we're in at, that's 15 points. So we're in at 32, and it drops all the way, almost 100 points. Same thing at 9 o'clock. We are in a bullish PD array right here. We're respecting it. The bodies, we got wick down, but the bodies are in there. So as soon as you see this, Right here at 10 o'clock, I'd be in. You could be in, you know, in this wick coming up, 667, 10-point stop, and then, we explode to the upside. 669, that's 20 points right there, and that's just 3 minutes, but we end up all the way up here. When you're bearish and you're going counter trend, you do have to look at, swing points. So when you take out this swing point, especially with the PD ray up there, you want to be wary of that. So we didn't even make it up there. We're so weak right now, but I would definitely just take your 1 to 2 on a counter trend idea. But that's just a quick example, just cycling through the lower time frames. I'm using the higher time frame as the direction. We're going down, um, and we've been showing that we're creating, market structure supports the idea that we're going lower. So that gives me, I wanna be going short until market structure shows something different, and that's why I trade the macros because it eliminates a lot of bad trades. Because you've got your 20-minute window, it's going to do one of two things. It's going to go to a fair value gap, or it's creating a swing point. So if it's not in a fair value gap during that time, I'm not going to trade it, and I'm just going to let it pass. And that's how I've been successful when I stick to that model and that plan of action. I do very good. When I just get on my phone and act like I'm smarter than I am, that's when I get in a lot of trouble. So we got to get back to the basics, what got us here, and I promise you, if you go back test this on any macros, you'll see if you can be disciplined enough to trade during those time slots, your trading will improve a whole lot. So I hope this helped you. I appreciate you. God bless you, and good luck trading.